Thank you for tuning in. I am your host, Joseph Martin. Hit that like and subscribe button to support the channel and hit that bell icon to receive notifications. One of the simplest ways to build generational wealth is understanding and having whole life insurance. The next step is making it a part of your family's financial plan and passing the information and policies down from generation to generation. People that don't understand the benefits of whole life insurance think if it's something they're going to have to pay for and it doesn't benefit them, that is stupid. I'm not paying for something that's going to take away from my purchasing power or my income now for somebody else to spend later. And I get it, because that does sound crazy. What's not crazy is that we do understand none of us are going to be here forever. The other reality about this is not knowing when we're going to leave. The most valuable thing wealthy people pass down to their loved ones is not their money, believe it or not. It's passing down their financial habits. They discuss financial strategies and exchange information in casual conversations, not just during financial emergencies or a family crisis. Now, on the other hand, poor people avoid casual conversations about finances and keep financial information to themselves. So yes, the rich get richer and the poor get poorer. Not because the rich are keeping the poor poor, but because the rich are doing rich stuff and the poor people are doing poor stuff. Wealthy people understand that death is part of life, and everything that they accumulate here on earth in this life is going to be passed down to someone else. So once you understand that wealth is generational and passed down to your family, this should make you look at marriage as a financial strategy. Marriage is a part of a sound financial strategy. That's why marrying the right person is so important. Throughout history, when studying wealth and royalty, arranged marriages weren't based off love. They were based off strategic alliances. It wasn't just the joining of a man and a woman, but the combining of families, strengths, weaknesses, and bloodlines. Having children out of wedlock, especially by multiple people, is a horrible financial plan, and it actually complicates it because it weakens your financial fortress. When all of your children are under one roof, it's easier to teach them your values because they can watch you and talk to you every day. Before we discuss the 4 major benefits of having whole life insurance, this is not financial advice. Read the disclaimer in the description. Let's get to it. The 4 major benefits of having whole life insurance are: 1, it creates an immediate asset once the policy is open. 2, it acts as an investment you can borrow from that grows with interest tax-free and pays dividends. 3, it leaves money behind to cover your final expenses. And 4, gives you or your loved ones the ability to grieve without worrying about finances after a passing, especially if the loss was a breadwinner. The main reason this video is going to be so valuable to you in your financial goals is that it's going to educate and inform you, which brings us to lesson number 1. Hire the right agent. There are 2 major issues with having the wrong life insurance agent. I'm going to start with the good news first. These will only be issues for you if you're not informed before you talk with an agent. If you don't take the time to educate yourself about life insurance, at least to have a basic understanding, everything you know will be just based off of whatever the agent tells you. The key is to know what you want. The first issue could be that the agent doesn't fully understand how the different life insurance products work beyond the death benefit. So they can't explain something they don't know. Them not knowing the answers to your questions or concerns at the time isn't the problem. The problem is when they don't take the time to find out. If you ask a question they don't know, they can say, "Let me look into it," or "I'll get back to you on that." It's their job to make sure they can address your concerns to allow you to make the best decision for your situation. The second issue is a case where the agent knows the information, but not offering, sharing, or explaining it. Believe it or not, this is how the average person does business. They rely on the person they're doing business with to educate them. Guys, this is bad practice. Invest the time to find out what you want and how it works before you do business. This will help you figure out how much the other person knows or how much they're willing to be helpful. It is possible that you could be asking all the right questions to the wrong person. Getting the right policy is too important to rush it and run the risk of setting it up wrong. Lesson number 2. There are 2 types of life insurance companies. When you open up a life insurance policy, the payments that you make towards the policy are called premiums. How those premiums are used depends on the business. So yes, the structure behind the business matters. The 2 types are mutual company and stock company. The simplest way to explain it is that the policy holders are the owners of the mutual company and the stockholders are the owners of a stock company. Why does this matter? I'm glad you asked. Owners want the profits to go to them. The money that the policies earn will benefit the stockholders more than the policyholders in a stock company. But since the policyholders in a mutual company are also the owners of the company, any extra money the policies earn will be given to the policyholders, which brings us to lesson number 3. Life insurance dividends. This is how mutual companies return money or pay the policyholders who are also owners of the company. Life insurance companies do not just use the money they receive from premiums to cover death benefits and other operating costs of the business. Life insurance companies are usually excellent at making investments, calculating risk, and operating under budget. This usually results in the company having a pool of extra money left over at the end of the year. In a stock company, that surplus would be returned to the stockholders. But in a mutual company, it will be returned to the policyholders in the form of dividends. These funds can now be sent to the owner of the policy directly or reinvested back into the policy tax-free. Which brings us to lesson number 4. Cash value. Earlier, I mentioned 4 major benefits of having whole life insurance. One of them was the fact that it acts as an investment you can borrow from that grows with interest tax-free and pays dividends. The disadvantages of using a creditor for a loan is that your approval depends on your credit score, your income, collateral, a cosigner, just to name a few. And the other major issue is that you'll have no idea what your interest rate will be at the time you need the loan. Having a whole life policy with cash value you can borrow from solves all these issues. First, your approval is guaranteed because the loan isn't based off your credit score or your income. The policy and cash value is used as collateral for the loan, so you don't need a cosigner, and the interest rate is fixed. So you know exactly how much your rate will be whenever you take out a loan. There's only one qualification. You need to be approved for a loan against the policy and cash value, which brings us to lesson number 5, the 4 key roles in a life insurance policy. Knowing the roles in a life insurance policy is extremely important, and the role that has the most control is the owner. And that's who you have to be to take out a loan up to the cash value in a policy. The owner is the only person in the policy that is authorized to make changes and to take out loans. The payor, that's P-A-Y-O-R, is the person that is responsible for paying the premiums. So the person who controls the policy, the owner, can be different from the person responsible for paying the premiums. The insured is the person's life the policy has insurance on, meaning the death benefit would be paid out in the event of this person's passing. And lastly is the beneficiary. This is the person who will receive the death benefit. Again, this could be someone different than the owner or the payer. Having the wrong person in these roles can have a major negative impact on your financial strategy. And in most cases, you wouldn't want the insured to be the same person as the beneficiary. Guys, worrying about how you're going to pay for someone's final expenses after they pass is a horrible financial strategy. I'm sure you've seen it before. Families having to resort to fundraising, asking, begging, and borrowing to bury a loved one. And the most popular thing right now is a GoFundMe, when the fact is you can fund you when you have a financial strategy. Don't put yourself or a loved one in a situation where mourning has to be put off until how the final arrangements are going to be paid is figured out. If you can't afford to pay higher premiums as a financial strategy, at least get enough coverage to pay for the final arrangements. You already know. I hope that you learned something, and I hope that you earned something. Hit that like button and put your thoughts down in the comments. Let me know what you guys think. Make sure you check out my other two channels, Original Greatness Shorts and Original Greatness Uncut. Make sure you stay tuned for part 2 on whole life insurance, and check out the next video. Take care and God bless.